Very good morning to all of you, and welcome to day 3 of TSS 2021. And it's been a great journey so far last couple of days, and we've been having fantastic conversations on various topics. And we had great panelists and speakers, and I'm sure most of you would have got best out of these conversations. And this morning on day 3, on 6th of October, we have a fantastic conversation on the topic of investing in the age of uncertainty, building a sustainable and resilient portfolio. So we have fantastic panelists along with a great moderator. I would like to introduce Nishant Agarwal from Mumbai. And he's a veteran in this space, and he's going to be the moderator for this morning's conversation. And Nishant is a managing partner and head of family office at ASK Wealth Advisors. And as I mentioned, he's been in this space for a long time, and he's been an iBanker, worked with global investment banks for many years. In the last decade or so, he's been part of ASK Group, and he's also a wealth management expert. And particularly in the sustainable space, he's has many feathers in his cap. So I would like to hand over the floor to Nishant to take it forward and introduce the panelists and as well as take over the discussions. Nishant, over to you.
Thank you, Hari, and a very good morning to everyone and my fellow panelists. Very excited to be in this session today with this really learned group of 3 smart gentlemen talking about investing in this age of uncertainty. Let me quickly introduce the 3 panelists before jumping into the topic at hand. First, I would like to invite and welcome Mr. Nakul Zaveri. He is from Relativity Investment Advisors. Excellent experience of more than 20 years, both in terms of entrepreneurship, operations, as well as investing activities. So one thing between the 3 panelists, we have a very myriad list of people with experience in private investments, public market investments, entrepreneurship, as well as an operating role. So Nakul brings all 3 together in one package. He comes with expertise in originating, executing, and managing investment. And not only in India, he was earlier with Global Environment Fund as well as Climate Change Capital. So his focus has always been investing with a purpose, investing with an impact. And that is what brings us to a very interesting way to look at investing, which makes ESG quite relevant in investing. So welcome, Nakul. I look forward to interacting with you on this. Next on the panel is Mr. Nilesh Shah, respectfully and popularly known as Nilesh Bhai. I don't think Nilesh Bhai needs too much of an introduction to this panel. A public face from the mutual fund industry, very well covered by media, and speaks his mind out when it comes to matter of investing, financial planning, and getting all investors get the best of investing in the manner. Currently, he is the managing director at Kotak AMC, but before Kotak, he has held various roles in investing world between Axis, ICICI, Templeton, and ICICI Securities. He's a gold medalist chartered accountant, merit holder, cost accountant, and the beauty, I've interacted with Nilesh Bhai many times in the past, is that he explains the subject at hand with so much of ease and finesse that his expertise is simplified in a manner that it can be understood by one and all. So I'm sure you will all enjoy the interaction with Nilesh Bhai as well. Third, a very experienced professional, Sunil Goyal, managing director, co-founder, and fund manager for YourNest. Sunil Bhai will bring a great amount of experience actually on the startup world. His mission or his belief is in conscious capitalism, which means growth which comes along with impact and ESG parameters in play. Before starting his journey as an angel investor and a fund manager, he has worked in industries and industrial houses like Dabur and Bharti Airtel. And before starting his fund, he has actually been an angel investor himself, with a member of Indian Angel Network, Mumbai Angel as well. So he's a qualified CFA, cost accountant, and an MBA from University of Delhi, and look forward to interacting with you as well. Now, let's start the discussion on this matter on investing in this age of uncertainty. Bringing the ESG parameters in the fray, let me start by getting the views of very experienced panelists on how they have seen the journey of investing evolve over their career of last 20-25 years with ESG and sustenance in mind. So Nilesh Bhai, you have seen the markets for over 25 years. You have seen the days with very low disclosures, very limited focus on sustainability. to the time when CSR got introduced and to the time when investors are asking for ESG and sustainability scores. So how have you seen mindset changing for you as a fund manager and the market as a whole? So let's set the context from there. And
thank you, Nishant, for those kind words of introduction. If we actually look at ESG investment, it's not something alien. When Tata set up their first textile mills in Nagpur called Empress Mill, they had provided facility for workers where they can bring their younger kids while mothers were working. They introduced Provident Fund and gratuity even before those concepts become law. Over the years, if we see in the market, good governance always provided better valuation, better access to capital markets, and many industrial houses were practicing that. Now what has happened is that ESG, which was remaining in the background, is now in the foreground. ESG, which was remaining more of a choice, is now becoming default. And this is a very good thing. Today, all of us want to make the world a better place to live. And what better place than making investments contributing towards that? Environment is deteriorating. There is a need for a corrective action. We all are responsible for improving society, and corporate citizens through their muscles and money can play a big role. Governance is necessary so that minority and majority shareholders share same benefit. Now, on the ESG side, I have just one differing point. If you look at from an activist eye point, then everything done by fund managers or investors on ESG is not good enough. However, this is a process. It is a journey. I can't reach destination on day one. My primary responsibility is to make money for my unit holders. And at the same time, I have to contribute towards making world better. Number two, the ESG standards which we are getting from Western world, we may not be in a position to apply to our part of the world in totality. And I will end my point by sharing this incidence. At Kotak Mutual Fund, we signed for UNPRI. We were the first mutual fund to sign for that. And based on that, I had gone to meet a company saying that you should improve your ESG score and so on and so forth. Halfway during conversation, the CFO cut me and said, Nilesh bhai, chai piyenge? And I said, sure. And he said, I'll, get you real tea, not this dip wala tea. So we went outside of his factory gate, and there was a small tea shop over there, and he ordered 2 cups of tea. And surely a young boy, brought the tea. And then the CFO asked me that, why don't you ask this young boy, why is he working over here and not studying? It's a child labor. I knew I was getting into trap, but still I asked. And that young boy replied that, sir, मैं अपने 2 भाई बहन का ध्यान रख रहा हूँ. To the world, he was a young boy, but to me, he was a, adult person taking care of his family. Now, if I apply child labor norms of Western world, I may end up creating disturbance in the lives of chotus and so on and so forth. So we have to definitely move on the path of ESG, but we need to modify so that it is suitable to Indian standards. And more importantly, we have to implement in a manner where the pace does not disrupt the businesses, does not disrupt the value creation, and yet contributes towards making world better.
Sure. No, that's very well put. And that was one of the thoughts which even we keep deliberating about, the challenges between developing and the emerging markets. And can we use the SOEM rule of thumb for both? And at this point, maybe I'll ask some Nakul to share his experience, Nakul, with your experience of working at Global Environment Fund and Climate Change Capital. How do you see the world differently when you look at developed markets versus emerging markets like Brazil, India, or some of the Southeast Asian nations? And is there a stark difference? And would, as investor, would you lower your standards on ESG parameters in one market versus the other?
Thank you, Nishant, and extremely It's a pleasure to be here. It's a great session, and over the last couple of days, we have seen this topic being repeated multiple times. I think, I did my first environmental finance deal in the late 90s when I was part of Arthur Andersen. I was fortunate to be one of the few people globally who was pushed into this. It was absolutely by chance. This is when, on the back of Kyoto Protocol that was signed, I don't know if many of you know, but this is what spearheaded the environmental finance markets across the world. The epiphany didn't come at that time, but I know somewhere value was migrating. It was at an extremely slow pace. At Climate Change Capital, we were managing over $1 billion in the mid 2000s. At GEF, since the late 90s, there were again, $1 billion. So we were ahead of the game. But the reality is that when consumer is demanding sustainability in some sense, when capital is moving towards sustainability at some sense, when technology allows sustainability to evolve, and when regulations is pulling sustainability, the stars are aligned. And the value migration cycle becomes irreversible and persistent. I strongly believe, and we relatively strongly believe, that this is happening right now. Value is migrating towards sustainable business models. Some will move there slowly, some will move there fast. The West may move there faster, we may move there slower, but it is moving. Also, the fact is that some businesses have a short-term life. I mean, you can't take away that, right? I mean, all of us are moving towards health and well-being. Those are irreversible trends. And we are seeing some of the mega trends happening. For example, climate change. I remember, in the mid 2000s, when people used to ask me, what are you doing? It was difficult to explain to them that I used to do climate change investing. They used to say, are you taking subpar returns? And we said, no, we're not looking at subpar returns. We're still not looking for subpar returns. And Nishant, to your point, and Nilesh also framed it quite nicely. If you ask me what is sustainability, if you take the noise out, it essentially means the ability to endure. And when you start thinking about long-term endurance and resilience, we can't be different from the West anymore because of transparency, because of technology, and because of capital that is coming in. And therefore, I believe if we are able to move towards best practices, and some companies have gone beyond best practices, value creation and value capture becomes unprecedented. And ESG is not a magic bullet. It's an additional layer. It's a filter. A fossil fuel company can be an ESG compliant company, and an electric vehicle mobility can be an ESG compliant company, but both are not sustainable to the same extent. So the point I'm trying to make is that ESG is here. It is dependent on company which takes it faster, better. If we want global capital to come in, I think we'll need to step up. The true cost of doing business will only be known when you integrate non-financial material metrics to traditional financial analysis. That's how I think about it.
Thanks. And maybe Sunil, from you, I would ask, as a startup early stage investor, the dichotomy which we feel in the emerging markets versus developed markets, I would say in some way, the same challenge would be in the emerging companies or the startups versus the fully grown up, evolved companies and business houses. So do you see those challenges of investing or finding the whole mindfulness for ESG parameters in startups which are just trying to stand on their feet, get capital, cost conscious, I would not say cut corners, but using Indian jugaad to get their way through. So does ESG parameters take a backseating in those kind of situations? How has your experience been?
Nishant, first of all, compliments to TiE Hyderabad for putting up a topic of sustainability and bringing it up front for all of us to discuss. A number of points out here are raised. Yes, as a technology investor, you've used the word for me, conscious capitalism. And this is the phrase that I was introduced in 2010 by the author of the book, Raj Sishodia, from Babson College. And he happened to talk about endearing organizations. living with a purpose and the vision, and how did they create. And right after that, we conceptualize YourNest after my interaction with that particular topic. And I must say, it's the easiest of deal to sail through ESG with the current age entrepreneurs who are coming by. They naturally imbibe every element of ESG in their way of working. These are technology startups. These are people with very well-do backgrounds. These are coming from people who had the means. Actually, they talk about climate, they talk about not using leather, they talk about so many other factors that they say that they have all the means in the world from their parents. And now they're trying to create something for the next 10, 15, 20 years for the world. And they want to do it with a goodness. Even if we do not introduce and talk about ESG parameters, they're living in day in, day out. That's the first aspect that we have seen in them. Transparency is one word. Transparency for me is that the moment any financial data is prepared by the analyst, simultaneously that particular data is sent to the founder and sent to the investors. Now, that is the level of transparency these guys, because they have to move faster. They can't be, okay, first show me the financials, then I'll do some plus and minuses out there and then send it to the investors, etc. This cannot happen in our fast moving, volatile world now. It's like velocity of things are very, very high in a startup world. That's one example of transparency. The one challenge I do face when we are taking investment decisions, we use AI, robotics, drones, for various decision making. We sometimes are investing in areas and sectors where regulation is not yet defined. Regulation will come by because technology is already in the forefront. Now, ESG guidelines caution us not to invest in any area that are not regulated or that can have some kind of offensive use in a military use case. On the other hand, we know that Israel happened to build its technology basis implementation in defense. So there are some dichotomies that go in our mind as to where exactly we should not be investing in. So that's one area that we keep on working and checking. And then, Nilesh, your story was very powerful. The only aspect we know this child labor is employed everywhere, every nook and corner in India. The only aspect that for a CFO like that, we will normally ask is, yeah, tum kya kar rahe ho to make his life better? Okay, if he is able to add something out there that we are doing so and so for health, wellness of his brothers, sisters, and to make sure that he keep growing and keep developing himself to a better entrepreneur in coming times, because he is learning entrepreneurship at his best. He is the best salesman that he would be knowing how to sell and upsell with the chai, something else, etc., etc. How he's going to be groomed as a better person.
So Sunil, if I may just ask from your experience in working with some of these large corporate groups in senior roles, how have you seen their outlook evolve over time? And have they paid a lot more heed and attention? I see probably 2014 when CSR guidelines were formalized as one way in which, at least for large corporates in India, to chalk out some part of their profits as CSR activities. But is it more of regulation which forced them to do so? Some sectors, some companies and conglomerates are very well known for taking care, and Nilesh did allude to a few in terms of setting up that. But did you see the mindset change significantly from internally driven thought after the CSR guidelines or after some of these things came to the fray with Bharti's, with Dabur or other companies in your fray?
Nishant, I'm blessed that I happen to get to work with the Berman family and the Sunil Mittal family. These guys hold governance, equality, diversity, equal opportunity, and the opinion counts of every employee. These are the things that are lived day in, day out. As far as social responsibility is concerned, it was naturally coming to them. Bharti Airtel, Sunil Mittal happened to dedicate 10% of their capital, of their net worth towards CSR. And I've been one of the very big propagandas or proponents of Bharti Foundation. 240 schools in tribal areas. When I used to take my teams for a day's volunteering activity to these schools, it was the most satisfying day of the 365 days of work that one used to be doing out there. And and you're going to very remote corners, into tribal areas, seeing as to how kids are playing and how kids are learning. Now, these cannot be put in by regulations. They are, as Nilesh mentioned, they come into these organizations naturally. So they live by it. So CSR guidelines were only enablers, not any dictum out there.
Sure. Nilesh, you worked a lot with retail investors and larger public and have spoken in many forums. What do you think should be the way in which a retail investor, while institutions have the might, they have the panelists, they have the research available to them, how should a retail investor approach ESG investing? What are the things and parameters he should focus on and choose managers or companies?
So, to my mind, ESG investment today, which is on the sideline and some extent desirable, but not yet there in the mainframe, will eventually move to mainframe. We will only have ESG investing. And if you're not ESG investor, you will be out of the business. And this shift is going to happen. Who can dispute that? Do we want better governance companies? Everyone will agree to it. Who will dispute that we need to create better environment? It's question of time before everyone agrees to it in totality. So there is a shift happening in investment world where today there are 2 or 3 mutual funds saying that we will be ESG compliant investors. Tomorrow there will be all 44. Today, when we are implementing ESG, we are probably not doing as much as we should be doing. But ESG regulations, they themselves are evolving.
True.
I went to one company who, as Sunil mentioned, have founders who genuinely believe in social development, and they've been spending tons of money from company as well as personally for better society. Unfortunately, they were not conveying that to the outside world. Their ESG report was quite pathetic. The work they were doing, they were not communicating. Now, moment you put them together, saying that whatever you are doing, please communicate, suddenly their ESG score improves. So ESG regulations are changing. There will be shift from satellite to core in investing. And retail investors, if they continue to encourage that through their participation, I think overall they will create a momentum in this field. Today, ESG investment is driven more by foreign portfolio investors. We became UNPRI signatory because one of our foreign investors wanted that. And then we realized how good it was. And then we said, why not we offer it to Indian investors as well? So they should just keep on supporting this endeavor of ESG investing. Despite there will be some noise saying that we are not doing good work, ESG is fed, and that's not how it should be done. But as long as we are moving positively, every day we are improving, that should be good enough.
Nakul, I think someone mentioned about the conundrum in the mind of investors about subpar return. And I think you mentioned that. And that's a big dilemma even I face in my day-to-day life. Whenever you talk about impact investing, whenever you talk about not the governance part, but at least environment part, the chemical industry with emissions and water treatment, or even something which is touching the life of the poor and the lower segment of the society, you have a tag of an NGO or not-for-profit also getting overlapped into sustainability. How do you solve that problem from a very common mind? And how do you approach this whole fear of subpar returns?
Yeah, it's an excellent question. And, when you look at examples, and both Sunil and Nilesh have mentioned some of them, if you see down south in Tirupur, where, the textile industry was there, I remember talking to a wastewater treatment plant 10 years ago, and they said most of the companies there wanted the lowest cost solution, because while the regulation was there, they wanted to just tick the box. What happened is all of them got shut down 5 years hence. So the true cost of doing business suddenly became real for them. And then they were searching for the best solution. So it is very interesting how in about 5 years, they realized that, listen, my true cost of business is what I know, what the others don't know. But my competition, if it is smarter and moving faster, they will be able to address this in a far more pragmatic way than I can. And therefore, now I want to get there. So there is a realization. We are seeing it from a company perspective, but the companies are still trying to address because inefficiencies in traditional financial metrics are still existing. Non-financial metrics, as they are called, they are difficult to quantify within our existing framework, especially in our accounting framework and our disclosure frameworks. That is evolving, right? So Europe is taking a first mover advantage, but there is a cost to it. There were other specialty chemical companies, as you mentioned, in the South Gujarat area. They were all taking their industrial hazardous waste and putting it outside. No one was processing it earlier, right? Because they weren't enforced. But the reality is they got shut down. So again, they started processing them. So the point I'm going to drive it as that if you are not able to generate superior returns, you are not able to scale it. If you're not able to scale it, you are not a commercial enterprise. We believe now with regulation being enforced, technology cost of data and transparency has gone down. And therefore, it's very easy for everyone to know what you're doing. True cost of business is out there. And people are trying to address that true cost of doing business. And the only reason they're trying to address it is because you want to deliver superior commercial returns. So we believe, and again, as Nilesh bhai mentioned, that this is going to be common sense investing, whether it takes 5 years or 10 years, but this is the only way where commercial returns will be delivered. In the West, again, I'll give you an example. When Kyoto Protocol was signed, America and Australia were signatories to it, right? They were very important elements. They moved away in early 2000 because they thought that their companies are not ready to adapt to it. And Europe took a play here, but they've come back. So is this time different? I would like to believe so. We believe that commercial returns are the only way to evolve this. Let's not also forget the third pillar of sustainability, right? Which is impact. Impact needs to be not only generated, but needs to be measured and verified, because stakeholders are getting very, very material to risk, return, and growth. So how we think about returns is what is material to risk, return, and growth. We need to integrate them at a certain level, and these will be different for different sectors, right? For example, a financial company is going to have very little to do with minimizing environmental impact, but it will have very, very high elements of empowering individuals and fostering equality. So it's also depending on which sector you are, which segment you are, and what kind of capital you are trying to put.
Like coming over to you, I think the segment which you focus on and invest in, which is tech, SaaS-based, innovative companies for disruption. I think one of the very clear mission and goal for disruption, as the word itself says, is to disrupt what is existing. And there you will go for things which is already existing and is causing more damage than good. And in my view, I've read somewhere, and it makes a lot of sense to say, moving sustainability or ESG from starting with doing something which is less harmful and move to a spectrum which is more good. So from less harm beginning to a more good is what sustainability should move towards. So when you look at some of these new age business, renewables, self-driving cars, whether you look at climate change and drones, is the thought emerging from ESG or environmental factor, or you see cost as the driver or as markets as the driver for people or startup founders to see of these opportunities? Because just to kind of add to that, and then I'll open to you, like somebody mentioned, Nilesh bhai mentioned about this whole young guy doing chai service. A lot of these technology from a social factor in market like India also disrupt employment at the rural and the lower end of the spectrum. So how do you balance robotics, AI, drones versus the delivery boy or the gig worker who's getting his employment by doing the job himself? So where does the balance lie in these two?
Nishant, a wonderful question out here. The key element is, any investment is driven by market. It is the market opportunity that drives us to do that disruption in technology. You talked about autonomous cars. Now, let me take the example of autonomous cars. Autonomous cars are going to be reality maybe in 5 to 6 years or maybe 5 to 10 years time. And we know that this is a technology that has to be developed. And if Indian startups do not develop it, somebody else will develop it. We cannot be left behind. And we as a venture capital is nurturing such technologies, giving wings to IP-led patents to be created by our companies so that tomorrow, when something like this starts happening, our IP is bought by these large mega institutions. Now, when they are going to be buying and they will be implementing it, we know the first person on the road who could be jobless is the drivers. It's a transition. It's a transition that is happening over a gradual period of time. Everybody gets to know that there are alternate professions that they need to get in. And those alternate professions will come by. And they will reskill themselves for the alternate profession. What we need to be doing is talk about these things, that this job is not going to be available maybe 5-6 years hence. Hence, you start preparing, you start telling your drivers that your next generation should not be driving, prepare themselves for a new role. So those are the areas that we need to be working on, but market forces make us deliver new technologies.
That's a very well said and very valid point, that the same thing about necessity drives innovation, or innovation is the other way around. So it's always the need in the market and the requirement which drives and pushes innovation and companies to adapt. Now, again, coming back to the investor's mind, and again, not coming from too many of institutional and global investors. In today's context, we are coming out of pandemic. Hopefully, we've seen a lot of changes. How should they realign their portfolios? And when I say portfolios, I'm looking at 2 or 3 levers, both listed market, primary and private markets, India investments and global investments. How are we approaching investments and portfolios in that? I'll open it for anyone who can take this. Should investor do something consciously different from what they have done so far, pre-pandemic, post-pandemic? Is there some light bulbs illuminating to say, okay, this is something which was not sustainable and now I have to think differently in their investing styles?
Nishant, let me take this one to begin with. We believe long-term shifts are very, very, very real now. So mega trends, as I said, are irreversible and persistent in nature. How we think about it, and I think that is the same framework probably I personally use and all, our team uses, and I believe it'll also be helpful for retail investors on the public side, is to understand where long-term trends are evolving, because it is very difficult to time the short-term market for retail investors, and likewise for us. Obviously, there will be cycles in the short-term market. There will be inefficiencies that are up for grabs, as you have seen in the last 1 year. But the reality is that when long-term shifts are happening, we're looking at some very obvious trends, right? So as you mentioned, in mobility, there is a transition to electric mobility. But that doesn't mean, India will transition overnight. It's a long way ahead. So where is that efficiency which will be early from a short to medium term and medium to long term perspective? We are talking about democratization of access, right? What are the platforms that are democratizing access to products and to services? What are the businesses that are providing resource efficiencies or optimization, whether it is technology platforms, whether they are data enablers? How is more and more population from India coming to that element which is available to a very small subset play? And we believe technology democratizes this. And again, Sunil mentioned some very interesting play that market is moving forward. Now we are also not decoupled anymore, right? So we are seeing a lot of models that exist in West on the consumer side very, very soon getting replicated fast. I think what COVID has done is, and what we call not the new normal, but the next normal. And that's why we are seeing massive amounts of urbanization, data generation, energy transition. We're talking about safety, convenience, productivity. Those are some of the themes that we are excited about. And I believe, some pockets of public markets also give opportunity to.
Also, picking on that theme from the pandemic time, what I call as business from home. People are going to work from home or business from business from home has changed mindset in many sectors. And one of the big debates was also around real estate, and especially commercial real estate, and whether there will be something which will see a bit of a downside. Along with that, you mentioned some very interesting global long-term themes, mobility being one, renewables being another. So, Nilesh, some of these old businesses, some of these legacy brick and mortar businesses, uh, you can talk about automotive, you can talk about diesel engines, you can talk about thermal energy. What kind of risk do you see from medium to long term from such disruptions in real estate, energy, cement, automobile industries if they don't keep pace up with industries? And there are a lot of those in the public market, I assume, which are going not in the desired pace as the world is changing. How do you adjust your portfolio? What are the risks you see?
So Nishant, one is from a business point of view, and then it is from investment point of view.
Mm-hmm.
The world will have to be like a trapeze artist. You are jumping from one place, carrying the rope, and before you catch the other rope, you should not let the first rope go. Otherwise, you'll fall flatly. And today we are seeing that happening. In many parts of Europe, they went after thermal power, nuclear power, and now energy costs are hitting them. They are facing shortages. If we, let's say, decide to move to electric vehicles tomorrow, do we have ability to produce those electric vehicles? Do we have ability to produce those batteries? Answer is no. We will bring the entire economy to a standstill. Can we move to renewable energies tomorrow onwards? Answer is no. We still depend upon thermal power to run everything. So this whole pace has to be gradual, calibrated. We have to move in that direction, but we have to move with the expertise of a trapeze artist who knows when he has to let go first rope and catch the second rope. If we don't show that expertise, we will create far more disturbance, which our economy or world can suffer. Now, on that, you have to make investments. You have to take a call. So today, when I'm investing in automobile company, am I looking at transition from fossil fuel to electric vehicle? Answer is no. I'm looking at transition from fossil fuel to hybrid vehicles to electric vehicles. When I'm looking at two-wheeler companies, are we straightway looking from fossil fuel to electric vehicle? Yes, it is possible that transition in two-wheelers may happen much faster than in four-wheelers. In every company which we are investing today, we are obviously evaluating them on their ability to adopt to digital ecosystem. Now, no company is ever going to say that I'm not adopting to digital ecosystem. Everyone is saying that. It's fashionable to make that statement. But you have to adopt faster than your competitor. You have to adopt better than your competitor. And if you are moving in that direction, then yes, it is worth putting money over there. Same way it is about ESG. No company is ever going to say that we are not looking at ESG seriously. But we'll have to check whether they're delivering on what they're promising and are they improving quarter on quarter, year on year or not. So this is going to be a very, very delicate investment as well as business decisions. I hope and pray that we make those decisions with the expertise of a trapeze artist.
Tell me, Nilesh, in the team which meets company management, does research and analysts, or go for these large listed companies meeting, how often do you come across investor community proactively asking questions and rating companies? Because I read somewhere that there are more than 40 companies which give ESG scores. And a lot of them I felt are more from an exclusion principle that, okay, if you're doing ABC, you are not good enough and hence you have negative score. But there is no one standard, a CRISIL equivalent rating or a LED equivalent rating for ESG score. So how do analysts grapple with this issue of rating companies and asking the right questions? Are they trained? How do you address that?
So Nishant, let's accept the fact that we are not expert on ESG. I have reasonably good knowledge on governance, but I am not expert. On social standard, again, we have some knowledge, but not at all expert. And on the environmental side, we are not even, studying, forget about being expert. So how are we trying to tackle it? So when we realize that we have serious shortcomings on environmental side, we joined a group called Climate Action 100. This is a group of global fund managers where they have identified top 100 polluting companies. About 6 of them are in India. And they, this global fund managers have created 25-30 member team on various aspects, environmental, social, governance. So when they engage with these 6 companies, we are junior partner. We are allowed to be in that meeting. We hear what questions they are asking. We hear what are they monitoring quarter on quarter, year on year. And then we try to copy it in our research, in our meetings with other companies. Now, is this the best way? May not be. I should have gone and recruited environmental doctorates, but as of today, I'm not in that position. But we are learning to adopt so that we can ask right questions. Number 2 is on the social side. Here we are taking help of some of the NGOs in the companies in which we are operating. We carry their questionnaire to the company management. And one good part is that most of the companies in which we have invested, they are fairly open to suggestions. It's no longer a lip service. It is serious commitment on their part. And finally, it comes on the governance side. Now, on governance side, we are reasonably good knowledge of what is right, what is wrong. Now, again, here, I can't copy Western standards blindly. One of the proxy voting agency had mentioned that the CEO of a very, very large respected group should not be appointed because he's 75 years old. We opposed it tooth and nail, saying that, you can't just apply all 75 years old persons are useless. If that gentleman is not that part of that group, the market capitalization will collapse. So we take our own decisions in consultation with the mutual fund insurance managers, and we generally try to push governance standards, which we believe will create value. Now, again, there are some managements which are far more open to suggestions. There are some managements which are much close. But by and large, we are seeing improvement. And we must acknowledge the support we have received from the regulators. The related party transaction, which needs to be approved by majority of minority investor, is a shot in the arm. Earlier, when promoters had majority holding, they didn't care for us. Now they have no option but to listen to us because we can vote with our feet or we can vote with our votings. So it's an evolutionary process. Things are changing. We have made a small journey. We have miles to cover. But my objective is that every quarter I should be better than the previous quarter.
Very nice. So another thing is about bringing in this whole awareness and habit of ESG or these social impact parameters very early on in the life of an individual. So like a very successful mutual fund Sahi Hai campaign started with educating the investor about benefits of investing in mutual funds. A follow on of that or something of that in terms of getting the awareness quotient high. So what any of you take this, Nakul, Sunil, Nilesh, by how should the government or the policy making bodies should start maybe in schools, maybe an awareness program, so that people are a lot more mindful of what can be done and what is being done, and then demand and expect, because the first thing is about awareness before you start asking for it. And so do you think there are certain changes in regulations, government interventions, industry bodies who can proactively make people aware and informed so that the trend kind of catches up all the way to the lower lines of the society?
Let me start. I think it's happening. I've got 2 young kids. I think they are taught, they are the idea of recycle, reuse, reduce, environment is reinforced pretty much every day. For example, if I'm using a plastic straw, my little one will say that why using it, right? It's embedded in the systems. And that again goes to what Sunil said, that to the younger generation, this comes very, very naturally. And they question if that is not happening other way around. And that's why you're seeing brands, which are the new D2C brands, kind of bringing in that element into their marketing as well. Second is, I think you very rightly asked, the two issues, and just stepping back, one, the risks were quantification, right? And as Nilesh mentioned, that we are away from that. The quantification criteria is very, very, very ambiguous right now. So there are no standards, and there are multiple standards. SEBI is also treading in very carefully, right? It doesn't want to go put the cart before the horse, such that companies are not ready to implement it. But the second issue is perception. If you ask this panel here today, define ESG, there is no similar definition. Again, so therefore that definition has to be evolved, whether it is an industry body, whether it is a regulator, or whether it is the market, and it will evolve very soon. So when you take those two elements, you will see rightly a mixture of market forces, whether those are consumer-facing companies. You will see industry bodies, whether they are focusing on risk and efficiencies. And you will see all the way to schools, which are thinking about long-term sustainability at an individual level, coming up with evolution around understanding the purpose that we are all fighting for. Essentially, all of us are doing what? We want a good, healthy, well-being lifestyle, right? All of us have a very simple objective in life. And I think we are realizing where, because of COVID, I think that's our understanding is deeper now on how to get there, if not quickly, but eventually.
No, right. Anyone, Nilesh bhai, from a regulation point of view, you work with lot with SEBI, AMFI, and the regulation. How is government thinking evolving? Is this the same usual story of regulation lagging or coming behind what is already happening in the market, or is there certain ways you can see them spearheading these things and moving forward? And I'm talking more from an investor awareness point of view, because I know that the policy level some work is being done. I, as a very layman on the street investor, have not heard much about it or do not want how to follow it. So where is regulation on this?
So Nishant, the government can't be the only driver of this. It has to be a collaborative effort. If I believe ESG needs to be pushed as an investment manager, I should be going to SEBI and saying that please draft this regulations. Why should I wait for SEBI to draft regulation? And today we are seeing, at least in SEBI, they are constituting working group on virtually everything that impacts industry. Of course, they set the agenda. They don't allow us to set the agenda, and it's quite natural. They are the regulator. But then they involve us in drafting policies and regulations. We come together to create rules, regulations, which will improve, governance and even ESG regulations. So it's a collaborative effort. As I mentioned, ESG is not an alien concept. It was there unconsciously. Now we have to bring it into consciousness. And we have to work with government and regulators so that we can keep on evolving guidelines suitable to Indian standards and yet making significant contribution. The world should recognize that, yes, when I invest in India, they are going to honor ESG in true form, true spirit.
Oh, very interesting. One last point before I open up for Q&A. I'm sure there'll be people who have a lot of questions. We've talked about a lot on E part, the G part, and even the S part. But something which we haven't touched, and it's funny in some ways, is about the whole S part related to gender equality and equal pay. That's also something, and Nakul very rightly mentioned, the kids, at least in the metros, are a lot more aware about these ESG schools, thanks to the school and exposure and everything about reusable and gender equality. Where do you see your startup companies? I'm sure some of these very well learned, very well educated people being equal employer opportunity or equal opportunity employer, same pay. But is this something which is very consciously embedded in the mind? I see that in my kids very, very often about all these issues around gender equality and equal pay issues. How do you see that, Sunil, in the ecosystem of startups where you work? Participation as well as opportunity, both.
Two aspects, but before the trapeze artist context of Nilesh for EV, from hybrid to EV, etc. Just watch out what technology companies are doing and innovations that are doing. Yes, this time period that is there from hybrid to EV is the one enabling our companies to innovate and bring in technologies that is going to be scalable and making everything affordable around the EV side of it. And that is what we are investing in, knowing very well that this will happen, maybe 6 years, maybe 10 years, but we need to innovate for those technologies. So keep a watch on what our VC funded companies are doing. On diversity, equality, guys, startup valuations is actually driven by the market share of talent that particular startup has in that particular domain or a sector. It is not just about what kind of idea, market, and other things. It is about the quality of talent that you're able to attract. And the quality of talent today, even an iota of doubt that comes into a person's mind that you are not going after ESG parameters, even unconsciously, you're not going after them. You're not having equality of pay. You're not having equality of opportunity. Opinion doesn't count, etc. Any of these things happen anywhere, anytime. These guys quit that organization instantaneously. The number of town halls that our founder needs to organize, he's answerable to any question in the world. Means there is nothing that he can say or brush under the carpet. He has to address any insensitive thing that anybody, even a peon, may have done in the organization. He has to answer that. Sorry, my throat is bad, so I'll keep it small only. I'll restrict myself here.
So maybe now it was interesting to hear various, I would say, covered from various angles the whole issue about investing and this. We have one or two questions which has come up is about more and more investor demanding. I think it's a self answering question, and say that the investor feels that their money can do a lot more than just making return. What in some parlance is known as double bottom line, where I create impact along with making profits. And as demand for investors grow, I think the industry will also cater to those investing demand by bringing products which caters to those issues. So I don't think anybody of the panelists here would have any doubts or questions around that. As there's a pull factor there, the industry is more than happy to provide opportunities and options to invest falling into those, right? Any thoughts on the investor demand? Are you globally, do you look at Indian investors also wakening up here? Nakul, from your experience, is it still global? Are the Indian investors starting to demand specific funds?
Let me give you 2 points here, right? Again, I want to step back here. One is when you talked about gender equality, we are hiring right now. And we gave 2 equal place, for male and female. And listen, the amount of demand on top quartile fund managers for gender equality is there for hiring agencies is unprecedented in India. So to Sunil's point, it is so unprecedented that if you are a talent which is younger and not right for the role, you still get picked up, right? So I think there's a very conscious effort large tier investors are doing for gender equality. Obviously, it starts with people who have got very, very large funds. Second is that when it comes to demand, there is a very clear demand. Large investors globally are asking ESG compliance. There's no ambiguity here. And they're asking in different manners, whether you are active or passive, and there's a spectrum there. When you talk about Indian investors, whether they're family offices, HNI, I think we are still far away. They are willing to discuss and engage, but I think their universe is still limited. We have seen some very progressive family offices taking a global perspective, but I think it's a medium to short term play where these will evolve faster as well.
Oh, lovely. I think I never kind of kept track on the time, and we have come to the end of the session. It was very, very interesting and enlightening discussion for me. Thank you all the gentlemen for taking up these questions and sharing your experience. I really love the conversation. I've taken some questions from the chat box which people have posted. I've put that in my discussion. I hope you enjoyed the discussion as well. I thank you once again for being here on the panel, and thanks Chai Hyderabad for organizing it. Best of luck, and we look forward for a much better future and a lot of participation from all of us going forward.
Thank you.
Thank you.